Hey guys, so I wanted to do another post here, and I know it's been a while since I posted a YouTube video. I specifically wanted to talk about leveraged ETFs, and I just posted a new blog post on my Substack, Naive Financial Analyst. So we titled it "Why You Should Avoid Leveraged ETFs in the Long Run." So let's jump in. And the reason why I got interested in this is just because there's been a lot of popularity around leveraged ETFs recently. Just recently, actually, in the month of May, there was a new leveraged fund that was just issued that gives you 2x leverage on top of the ARK funds, which, sounds intriguing. But after I go through this math, you're going to see how this is probably not the best investment if you're looking to invest in any type of index in the very long run. It's really a great trading instrument for the day, but in the long run, it's not a great investment. So let's go through some of this math right here. So let's take, for example, a leverage fund that's 2x exposure. So we're doing a 2x exposure on the index. And let's assume that the index net asset value, NAV, is $100. This could be any index. This could be a biotech ETF. This could be TQQQ, which is the triple leverage index on the Qs, Nasdaq 100. But it could be any index. And in this example, we're using 2x. So the fund NAV, net asset value, will be $100 as well. Okay. But in order for this fund to have 2x leverage, it will need to use swaps to increase its exposure. So let's assume that they do increase their exposure by 200. By 2x. So now that the exposure to the index will be $200. But remember, the fund NAV is still $100. Okay, so that hasn't changed. They're just using swaps to get that exposure of 200. So let's say on the first day. So the first day, everything's 0%. But let's say on the second day, the index goes up by 10%. Remember, this could be any index. It could be the S&P 500. It could be the Qs. It could be some biotech index. Doesn't matter. It goes up by 10%. So what happens to the index? Well, it will go up by $10, right? 10%, 1.1 times 100 is 110, right? Now the fund NAV, though, that will increase by $20. Why? Because we had original exposure of $200 times 10%. We add that's $20 to the original NAV of 100. Now we have 120. So great, that's working just like we see here. The index went up 10%. The fund, leverage fund, 2x fund, went up by 20%. Great, that's awesome. Now things get a little interesting. So let's say that the index falls down by 10%. Okay. So what should happen with the fund? Well, it should fall down by 20%, right? So let's see the NAV. So the NAV for the index, though, falls down to $99, but the fund for the NAV for the fund will fall down to $96. Why? Because they had an exposure of $240. But why did they have that $240? So before that day occurred, the drop of 10%, it needed to increase its exposure by using swaps. So now if you take 2x times the 120, that's 240. So now it has a 240 exposure. But since that 240 got hurt by negative 10%, we can subtract that amount. And what is that? That's about $24 from the fund's NAV, and that's why it's fallen down to 96. So now when you look at the 1 day returns, everything looks fine, right? Goes up by 10, the index goes up by 10%, the leverage fund goes up by 20%. Falls down by negative 10%, the leverage fund falls down by 20%. Great. But if you look at the holding period return, now let's say that you looked at the 100, and the holding period to return is through this entire 3-day period from the index fell from 100 down to $99. That's a negative 1% return. Now, a naive investor would think that, okay, great, this is a leverage fund, I should have fallen only 2%. But in reality, this 2x fund fell down by 4%. You lost 4% of your money. Why? Because if you take this 192 divided by 200 minus 1, you get negative 4%. So that's essentially what's happening because of this math. I decided to chart it out here as well so you can see it in this chart. So you see that we have $100 NAV in the beginning of the day. Index increased by 110. The fund increases by 120. Great. But on the third day, index falls by $99 to 99, and the leverage fund falls down to 96. But that's all has to do because of that exposure change before the day. So originally it was originally at 200. Then the following day, in order to maintain that leverage, because the NAV is now at 120, it needs to have exposure of 240. So 2 times 120 is 240. But that next day we had a negative return, and so you can see that over the long run, you're actually getting a worse return of negative 4% than what you would expect over that time period of maybe negative 2%. So that's just 2x leverage. Let's increase this and make this a little more interesting and assume it's 3x leverage. And let's assume this is an inverse fund, okay? So negative 3. What happens now? Okay, well, again, we start with an index at $100, the net asset value. The fund for the NAV will be $100 as well. All right, so to have negative exposure, we'll have to use swaps, and therefore this fund will have a negative 300 fund exposure. But the NAV is still $100, okay? So that's the first day. Nothing happens. So let's say the second day occurs, and the fund goes up by 10%. What happens? Well, the NAV for the index goes up by $10, 10%. That's 110. That seems completely normal. But what happens to the fund? Well, this is an inverse fund, right? So if it should do the inverse. So the index went up by 10%. This should fall by 30%. But see what happens here. So we see that the NAV of the fund falls down by 30 to 70, and that makes complete sense. That's normal. Now let's say before the following day, they need to maintain this 3x leverage. So to do that, the NAV of the fund is now 70, but 3 times 70, we get 210. What has happened here? So where we have a 210 exposure, so we had to reduce our exposure in order to maintain that negative 3x exposure. But let's say so that's happened before the day. So now let's say the following day, the index falls down by 10%. What happens now? Well, same thing. The index, the NAV falls from 110 to 99. That makes sense. But this is an inverse fund, so it should increase by 3x, right? So that's what happens. The index falls by negative 10%, and it increases by 30%. That's great. So we take 30% of the 210, and we get that, and we add that to our 70 to get 91. So that's great. Now, you can notice on the one-day returns, everything makes sense. But if you look at the holding period return, and that's from the first day all the way to the third day, you'll notice, again, the index fell down but from $100 down to 99. That's a negative 1% return. Again, an inexperienced, naive investor would think, okay, you would assume this fund should go up by 3% because it's an inverse 3x leverage fund. But in reality, the fund fell down by 9% over that holding period. So you can see the math here, what happens when there's lots of volatility in the index, which there always will be. Unless you're going into the general direction of the strategy, you will lose money in the long run. And so the index will not, the leverage fund will not accurately represent the return of the index given that exposure. Okay, so I hope this math gave you a little bit of better sense of why leverage funds are not good for holding periods longer than 1 day, and I hope you can understand this in the future and use them what they're meant to be used for, and that's for day trading for the day, which is a whole other topic that we could talk about and how that may not be a great investing strategy for the long run as well. But now that you can see this math, I hope this can help you all out in your investing for the future. Thanks a lot, guys. Until next time.